Hello. In today's monetary policy statement, the Reserve Bank of India has left the repo rate and other key rates unchanged. This was in line with the broad market expectations. 5 MPC members voted for the status quo, while 1 member voted for a 25 basis point cut. The Reserve Bank of India has also maintained their neutral stance intact while marginally increasing their inflation forecast for second half to 4.3 to 4.7 from 4.2 to 4.6 amid firming of crude oil prices. However, the tone for policy appeared to be evenly balanced this time. The Reserve Bank of India has noted the recent improvement in India's ease of doing business ranking and announcement on recapitalization of banks. These measures will likely have positive impact on the economic growth going forward and will result in further improvement in foreign direct investment inflows. At the same time, the RBI has highlighted risk in form of volatility in food and fuel inflation, recent increase in crude oil prices and its negative impact on input costs, prospects of fiscal slippage due to decline in government revenue collections, and expected unwinding of quantitative easings in G7 economies. The Reserve Bank of India will keenly watch the developments going forward and calibrate their response. On liquidity, the Reserve Bank of India mentioned that they expected the current liquidity surplus to turn neutral around the middle of 2018. This could put some pressure on bond yields in our opinion. So what does this all mean for the bond market? The government bond yields nudged lower after the policy announcement as market participants welcomed the Reserve Bank of India's balanced policy tone. The benchmark 10-year government bond yield declined marginally from around 7.07 before the policy to around 7.03 in some sort of a relief rally and position squaring. With the Reserve Bank of India policy out of the way, market participants will shift their focus on the upcoming inflation as well as demand-supply dynamic in the near term. The risk appetite remains subdued amid lack of positive triggers and prospects of higher CPI and sticky core inflation and tightening banking system liquidity surplus. We expect bond yields to remain range-bound in the near term. The fair value of the benchmark 10-year government bond is likely to be between 6.75 and 7% in our opinion. We also expect a gradual widening of credit spreads in the medium term amid prospects of increase in primary supply and tightening of banking system liquidity surplus. We recommend investors to consider low duration and short duration fixed income funds which are focused on quality and liquidity as we brace for slightly higher inflation and improving global macroeconomic landscape in 2018. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.